All right. So Ashwani Bhatia also joining us now, MD of SBI. Lots to discuss as always. But essentially, SEBI has also been looking at those mutual fund investment norms, and we wanted to get Mr. Bhatia's, expert insight on this as well. Mr. Bhatia, thanks so much for joining us. Wanted to understand from you what you're making of the review and some of the suggestions coming in, and how this will impact things going forward.
So it's a very significant notification that has been taken out by SEBI. It affects banks the most. So just to give you a sense, if the total advances of the risk-weighted assets of the banks are today in excess of 100 lakh crores, the banks can raise about 1.5% through Tier 1 bonds. So that's a very significant amount, which is about 1.5 lakh crores or so. State Bank alone has an outstanding in Tier 1 of about 32,000 crores. Now, if we have to raise all this in a new arrangement where mutual funds have to price this at as a 100-year bond, I think the impact on the banking system is going to be very significant. So just to give you a sense, State Bank of India has risk-weighted assets of about 22 lakh crores. And the guidelines do permit us to put 1.5% through Tier 1. So as I said, we have between around 32,000 crores in the Tier 1 bonds, another 60,000 or so in the Tier 2 bonds. Now, if this capital market route for raising capital is gone, obviously, then you've got to do it through the equity route. And when you do it through the equity route, there are issues over there also, on our pricing, price to book, and so on and so forth. So to my mind, I think there is no issue as far as the intent of the SEBI guideline is concerned, which, they're trying to limit losses, limit concentration in portfolios and specific schemes. We have no issue with that. The issue, I think, with most players, including mutual funds, would be the pricing. And finally, there's no benchmark, very frankly. There's no 100-year bond to benchmark against. That is what is problematic. I don't think mutual funds are wary of investing in this, but this guideline on valuation, I think, is the issue.
But the whole concept of perpetual bond, Mr. Bhatia, it's very big globally. Now, one side we are saying that you want to align Indian bond markets with what the global bond markets are. We have a stock market which is one of the biggest stock market in the world, but looking at the size of the GDP, our bond market is not prevalent. Now, this entire move from SEBI, it's a pushback, isn't it?
I don't think it's a pushback. Number one, SEBI always looks at the interests of the smallest investor. Please keep that in mind. So, when we read the newspapers this morning, there are certain funds that have over 20, some of the funds have 30% of their funds in AT1 and AT bonds. Now, again, that is also not right. So the SEBI guideline of limiting the concentration to 5% or 10% within a scheme is absolutely fine. There's nothing wrong with that. But the fact that, you are supposed to price this at a 100-year yield, let's be very realistic. There is no 100-year CG Sec in the market. Globally, who values a AT1 bond at 100%? And there are many schemes, for example. I did come back to the bank from the mutual fund industry. Now, just think of short duration schemes or medium duration schemes, which have taken very small duration Tier 1 and Tier 2 bonds, and generally they are paid on the first callable date, which is 5 years or lower. And their duration would go for a toss. So what happens? So the pricing is going to start happening today only, for the simple reason that many of the customers would like to exit. Mutual funds would have no choice but to price downwards the tier 1 and tier 2 bonds. So I think in this scenario, it will be right if some kind of clarification comes. The sooner it comes, the better. Second thing, what happens is that suppose you have a scheme, you are unable to sell tier 1 or tier 2 bonds. You may then resort to selling quality. If you sell quality bonds, the yields there also move up. And at a time when Reserve Bank and government and others are trying their best to, ensure that the yields don't go, they remain within a corridor. Reserve Bank of India has said that the yield curve is a public good. So all that throws the entire arrangement into some kind of tailspin, if I may use the word. So I'm very hopeful that some guidelines, some instruction will come soon on this.
Okay, that's the bank perspective. Now let's understand the mutual fund perspective. Like you said that you have a mutual fund backdrop. We all know that. You were running SBI mutual fund couple of months ago. What happens for the mutual fund industry? Because the perpetual bond or some of the bonds, they are not like a very large category.
True. So, the mutual fund today is a 31 lakh crore industry. 50% assume would be on the debt side. And the exposure of the mutual fund industry in tier 1, tier 2 bonds is around 36,000 crores. That's not the point. The point is that although 36,000 in a 15 lakh crore debt AUM may appear small, but when you take it in totality in the sense that if you take the sum total of the schemes where these bonds are invested, the amount then becomes huge. You start having redemptions not only in credit risk, but you start having redemptions in short duration, medium duration. And, it takes away the confidence of the investors. Yes, there have been mishaps in the past. Yes Bank was one. Lakshmi Vilas Bank was the other. And I think mutual funds have been extremely careful in their investments. So it takes away confidence. Finally, we are managing other people's money and we need to be very careful about that. And you do have to have risk limits. SEBI has brought out that aspect very, very clearly. Again, as I said, no issues on that. The issues is only on the pricing. That will be very, very problematic for the industry and will actually take away confidence from the investors.